Today on InvestTalk, we discuss how the Fed rate cutting cycle will impact gold prices, and if Unity software is a buy after dropping more than 90% from its highs.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, July 8th, 2024 edition. I know Luke was on Friday, so I will say I hope everyone had a wonderful holiday weekend. I know the temperatures are warming up here in Southern California, and the big question on everyone's mind, will volatility in the markets also start to head higher as we get through the summer and into the back half of Q3? My simple answer to that is probably, but that also doesn't mean that everything has to go to hell in a handbasket. Oftentimes, markets need to reset, markets chop sideways, pullbacks are inevitable, they're part of equity investing, and most of the time, they are actually healthy. Okay? And we're going to dig into what's happening in markets, as well as, of course, your finance and investment questions. That's always number one. Trying to navigate these difficult times. It's a new era. Higher interest rates, higher inflation, obviously geopolitical tensions, domestic political tensions, etc. And so we're here to navigate you through this time so that you can make informed decisions, avoid the pitfalls, and capitalize on the opportunities. It's hard to do that consistently. You can do it here and there, and everyone, even a blind squirrel finds a nut sometimes, but we don't want you to be the blind squirrel. We want you to be the one with your sight, with your eyes wide open, able to navigate these markets. And we do that by giving you actionable material and data, as well as answering your finance and investment questions to help you on your mission, which is head towards your own version of financial freedom. So in just a bit, we are going to talk about today's market performance and run down the show topics. But first, let's tackle this caller question now.
Hey, InvestTalk. Question regarding an annuity. My mother has an annuity that she's been in for about 15 years now, and it's a fixed annuity that pays about 4% per year. I think she has about a couple $100,000 in there. Nothing crazy, but nothing to seize that. I wanted to get your thoughts about withdrawing that money and taking the tax hit to redeploy in, something like an index fund, or even now money markets are paying over 5%, also bonds paying over 5% as well. So wanted to kind of get your thoughts on that and, possibly taking that out to redeploy and just taking that tax hit. Love the show, and I'm looking forward to hearing your answer. Thank you so much.
Well, that all depends on the surrender charge. Okay, I know in most annuities, you have 8 to 10 years before you can take the money out. But it's everyone's different. I always say this about insurance contracts, and Steve taught me this a long time ago because he was deeply in the insurance business. And it was, these are large contracts. The salesperson, the insurance company, the broker, whoever you're interfacing with is really only going to focus on the high level selling points of the annuity. But it's up to you, the buyer, to dig into the details and understand things like surrender charges. And so said she's owned it for 15 years. She may be outside of that surrender period, most likely, and maybe she can roll that into a higher yielding annuity. Also, she has to figure out, does she need this annuity anymore? Does she need that income, right? I always say annuities are only good, only fixed annuities are pretty much good. Every other type of annuity, most of the time, they're high fee. They're not, there's a lot of devils in the details, right? So I'm glad she's in a fixed annuity, but 15 years on, does she need that level of income? Maybe she needs more income. Maybe you can roll this into another annuity. Now, you talked about money markets earning 5%. That could change. the Fed is likely to cut rates 1 to 2 times this year, probably even more next year, especially if you get a Trump presidency. He likes lower rates, so I'm sure he's going to get a Fed chair in there that's going to kind of keep rates low. So you're not going to be guaranteed that 5% yield on money market, I think, for much longer. So, but when you own a fixed annuity, that's a duration asset. And your mom is, or you are looking at this the same way as somebody with a long-term bond. And it's basically, hey, do I want to keep this level of income, or can I now roll it out? The good thing with this, maybe you can sell it. It all depends, or cash it in. And I would look to do that if you can. And if you want to talk to me further, I would maybe send over the annuity contract to me. I can read it and give you a sense of what you should do and what are the best options, and just figuring out whether your mom is on the right track in her retirement. Thanks for the call, thanks for the call. Now we're heading into a short break, and on the other side, I'll run down today's planned topics and talk about today's market activity as well. Please remember, you can call anytime and leave your questions on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit investtalk.com and submit your Let's go to Dan in Walnut Creek. He wants to talk about sell orders.
Hey there, Justin. How you doing today?
Doing very well. What can I do for you?
Good. Hey, yeah, I called last week and asked about selling some NVIDIA, and I'm taking your advice on I'm going to sell half of it. Mm-hmm. Can you tell me what the negative aspects of sell quote sell orders? I'm not too sure if that's the right term, but I want to set a price, like if it drops to a certain point, then it'll sell. I'm thinking that maybe if it takes a big drop overnight or something, it might leapfrog that and it might not sell. But can you clarify that for me, please?
Yeah, so what you're looking at is a stop order or a stop limit order. Now, a stop order would be anytime the stock trades below a certain price, it's going to enter a market order. So you talk about it trading down overnight. So right now it closed at 128.20 at the close today. So let's say there's some bad news overnight, they pre-announce earnings or something, and your stop was at 125, shall we say, and it opens at 120. Okay, it's immediately going to put a market order in, and you're going to get filled around 120, right? Because it traded below that 125 stop. Now, if you put in a stop limit order, what it's going to do is, as soon as it trades below 125, it's going to put in a limit order at 125. Now, you're not going to get filled though, right? Because now it's trading at 120. So those are the differences between those two. Depends on what you want to do.
Okay, great. Yeah, I'm looking at the screen. It says my options are stop quote and stop quote limit. So I want the stop quote.
Yeah, exactly.
Sounds like great. Thanks very much. I appreciate it.
No problem. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now, we have a lot of ground to cover, and time permitting, we'll get to all of it. One is in regards to gold prices, and the Fed is likely to embark on a rate cutting cycle later this year. They've already embarked on an easing cycle, if you would believe, reducing QT from, I believe, a $60 billion per month to $25 billion already. That was the beginning of June. So they've already eased policy to a degree. But what will happen is they will likely cut rates between now and the end of the year once or twice. And the big question is, how will gold react? Okay, how will gold react? Gold price movements react based on that easing cycle. So we'll dig into the details there and what factors to follow. Also, earnings season's coming up. Yep, we're in the third quarter. That means Q2 earnings are coming out relatively soon. And per usual, the banks typically kick off the earnings season, and you're getting that starting next week. So we're going to talk about the good and bad to expect there, and how that impacts different companies within the banking sector. In addition, Vanguard, all about lower fees, but they have a new CEO, and he is trying to tackle a lot of clients that are, or at least a lot of them are, I wouldn't call them clients because it's just a brokerage account, but a lot of customers are dissatisfied. And we're going to talk about why and how this is a good story to show you how to measure the type of broker you should have. And the fact that it's not just always about the lowest fee, it's kind of the all-around experience. So we're going to discuss that. And then lastly, if we have time, government spending a lot of money, borrowing a lot of money. And that's putting strain on the Treasury market, according to a new analyst. And we're going to discuss that report as well. And of course, your finance and investment questions are number one. We will get to those live, as well as our voice bank questions. One is on Unity software and the other small caps. And we'll get to some questions submitted via the comment section of our YouTube channel. But once again, we welcome your finance and investment questions now at 888-99-CHART. Now let's take a look at the market today. It was a modest up day. You had large caps up about 11 basis points. Small caps did the best, up about 1/3%. It was pretty balanced, but definitely value did a bit better on this day, but nothing too dramatic that would tell you there was a major trend throughout the day. You had gold prices down and the dollar up a bit. The Treasury market was about flat, so not a lot of news there on that front. But I don't think we're going to get a lot of action before the earnings season kicks off. Like I said, next week there is pretty bullish expectations. There are pretty bullish expectations for the earnings picture for corporations. So we'll see if the market can, or see if they can fulfill those expectations and how the market will react. I will say this. You're getting a lot of what's happening in markets right now is market structure. It has to do with the way indexes are structured. It has to do with structured products that are big, that are sold by big institutions. There's also a lot of market making and option activity that moves volatility one way or the other. And we know higher volatility means lower equity prices and vice versa. And vol has been pretty compressed downward. You have the VIX now at, what are we at now? VIX is at 12, which historically is very, very low. When you're in the low teens, there's pretty much no volatility out there. And so I don't expect that to perk up in the short term, say July. But as we get into August and September, that will likely head a bit higher. How much higher, we shall see. There is a more hawkish Treasury where they're issuing more longer dated securities, and that will pull liquidity out of the market to a degree. And so there's definitely some liquidity headwinds as we go into the back half of the year, despite the expected Fed rate cuts. So I expect a choppier period between now and, say, the election, but we shall see. Well, let's go to, what are we going to? Are we going to a break? Yeah, we're going to a break. Still to come, YouTube comment questions and my main focus point. And Peter from San Jose, hang on. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Let's go to Peter in San Jose. He has a tax question, which are always my favorite.
Good afternoon, Justin. I appreciate your show and all the advice you provide us on a countless basis. I really love the show. Today's question, I just sold a bunch of stock and I have a large capital gains payment to be made. Is there any, other than selling other stocks for losses to offset the gains, are there any other tax strategies out there to either help reduce the gain or reduce that payment? That's my question for today. Thank you so much.
Well, if you have other assets besides equities, right, you could take losses on other assets potentially. This is something, once again, I always say you have to talk to a CPA. And this is a perfect example why a good CPA is worth the money. Might pay $500,000, $800,000, whatever it is, to get true consultation, to look at your entire picture, to say, okay, what are the levers you can pull to reduce that? It's usually worthwhile. Obviously, they're not there to give you the financial advice of what to sell to take those losses, but what are the possibilities? And you need to understand your full financial picture. These are things that we talk to with clients, even though we're not CPAs. We can give you a sense, we give our clients a sense of what their total assets are. We build financial plans so we can see all of their assets in one place, model that out going into the future, and say, okay, maybe we wait to sell these assets until next year. Maybe we do a little bit this year and then and more next year. And we plan that out and we figure out what makes sense. And so just a good piece of software can certainly help. And I think everybody needs to have their full financial picture in some sort of software. You used to have mint.com. That kind of shut down. I think that's been kind of co-opted and it's not really useful anymore. But everyone should have that to lay out where their life is today as well as in the future, right? What do expenses look like if you index them to inflation? What does your income look like if you index that to whatever your typical raise is each year, for example? What are your goals? Retirement, but maybe it's buying a second home or just a home in general. Maybe it's paying for a child's wedding or sending a kid to college, whatever that is. All that is important to lay out in context so that you understand what each little lever does to the entire picture. Because so many people focus just on taxes. I think that's one of the biggest mistakes people make. And I'm glad you sold some stuff. I don't know what you sold and whether it was the right thing to do or not, but I'm glad you did it. You took some gains. You didn't focus on, hey, I'm going to pay tax now. Now you get to the point where you try to limit that tax, and you do that in the right way, but you're not completely afraid of paying taxes at all. And I think that's important as well. So hopefully you have a good CPA, and if you want to, have a conversation about building a full plan, let us know, and we can have that conversation. Now, our main focus point today concerns Fed rate cuts and its impact on gold prices. And if we analyze past trends, gold has historically delivered positive returns during periods of interest rate cuts by the Fed. And the big question is, will this time be different? Now, if you look at the CME Fed Watch tool, you can see there's about a 94% chance there will be no rate cut this month, it's the end of this month in July. And then the next one will be all the way in September. But there is a nearly 80% chance that there will be a rate cut in September. And that is a pretty good indication. Usually when the market's around 80% chance priced in, there will be one. And the market, the Fed doesn't like to surprise the market. So if that holds and the economic data continues to be kind of middling to poor between now and the end of the month, you are likely going to get a Fed that will signal a rate cut in September. And then my guess is there will be another one in December as well. So I do think we get 2 rate cuts by year end, along with, like I said, the QT drawing down from 60 to 25 billion, and that may go to 0 by year end as well. But what's happened recently is that it's not just the Fed that's easing, but central banks really around the world. Okay. And that's what's important here, is that the easing cycle has really started already. Okay. And so, the big question is, what drives gold prices? Easing cycles are certainly one of them. And a lot of people look at it in relation to the yields they see on the screen, right? If the yield on the screen drops, then gold prices go up and vice versa. But that's not really the case. It's actually real yields, okay? So that's why in most instances, when rates rise, gold prices go down. But there have been, over the past few decades, there have been a couple instances where rates have gone up and gold also rose, okay? And, recently is a good example, right? Rates have been up, but gold's been up as well. Because real yields have continued to be relatively low because inflation's been higher, right? And so don't think of it as just yields down, gold up. It's real yields down, gold up. Okay? And usually how it works is as you go into the easing cycle and through the easing cycle, you have gold prices going up. Usually peaks around the time that the end of that cycle is expected. Okay? So I think you still have a long ways to go. We may likely not have an easing cycle that goes all the way back to 1 or 2% like we did in the past, but we are expected to see gold prices continue to head higher in the near term. All right, we're heading into a break. Give me a call now at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
On the next Invest Talk, we'll look into this question. Can quant mutual funds steady your portfolio in volatile markets? That story tomorrow, but for now, let's play another listener question from 888-99-CHART.
Hi, Luke and Justin. This is Carlo from Providence, Rhode Island, and I have a question about Unity software. I have a small positions, less than 2% of my total portfolio, and I'm wondering what you think about the company. I have a small position in it, and I'm down over 50% in the last 2 years. Should I hold it, sell it, or buy more? I appreciate your answer to the question. You guys have a great day. I love your programs. Bye-bye.
All right, this is Unity software, and this is an interesting one. Why is that? Is because this was a very hyped name in 2020. When IPO came out around $70 per share, went all the way up above 200 in November of 2021, kind of the height of the peak of the growth stocks. And it's fallen dramatically from 200 down to $16.15 today, over 90%, and near a 52-week low. So the relative strength is definitely poor, 5 on the relative strength meter. And this is a perfect example of one of those names that, it was all hype. Maybe not all hype, but mostly hype. It was all around 3D software, and it was all about the metaverse, and that these software developers were going to use Unity's software platform to create 3D environments. Okay, so think of 3D games, 3D virtual reality devices, etc., augmented reality, all of that. And I think that industry has continued to grow, but not to the pace that everyone had expected. They weren't making money back then, and they aren't making money now, although they are expected to earn profits this year and next year. Now, when a company has never made money and analysts are expecting it to make money, to me, it's always proof is in the pudding. Like, show me. Don't tell me, show me for once that you can actually do it. Now, the one thing that makes you say that they might be able to is their cash flow has gone positive. And it's been positive about $183 billion the last couple of quarters, trailing 12 months. So I like that. I like that that they are trending towards a more sustainable situation. They're not issuing more shares, etc. But I need something more from the charts. It has been improving. It's a little micro bullish pattern near term, but it's still way below the moving averages. And this is a name I'd probably keep an eye on because I see this all the time. And you can look at, the Cisco's of the world. We use that as the bellwether or poster child of the 2000 tech boom. It went up dramatically and fell 80, 90%, kind of like Unity. And from there, it's had good returns if you bought it after it was down 80, 90%. And you may see something similar with Unity, but the valuation still, it's not cheap, okay? It's not cheap yet. But the chart is improving a little bit. Cash flow is positive. Earnings expectations are there. So, it's one of those monitor stocks. Okay, it's down. It's at valuations that are not egregious like it was a couple of years ago. So there may be something there. I would continue to follow it, but it's not something I would add to at the current time. And if you own it, I'd be looking to take tax loss selling on it before I'd be buying it because, once again, proof's in the pudding. It's got to show something before you commit more money. Thanks for the call. Now, I hope you've been telling your friends about the InvestTalk audio podcast moving over or expanding over to our YouTube channel. And we get questions over there submitted. And Audrey, 1993A, says, I appreciate you guys switching over to YouTube as I am a better visual learner. But I still continue to listen to you on Spotify during my commutes. I was hoping to get your opinion on AOS. I have a very small position and was seeing if I should add more right now. Now, AOS, this is a very quality name, good profitability. It's in the HVAC space. We previously owned it for clients, but we did sell it on a bit of a worry on Chinese exposure because they do have significant exposure to the Chinese real estate market. And that's probably what worries us the most, at least in the near term, or worried us the most in the near term. We sold it a while ago. But it has pulled back from 90 all the way to around 80 today, 81.06, right around the 200-day moving average. So it's at support. I like the support level. Once again, it's a good business. Not growing dramatically. 7% earnings for growth this year, 7% expected next year, low 20s multiple. So what I would say is it's a quality name with high profitability. You look at return on equity of 31%, return on invested capital 28%. Go back and look at our webinar a couple months ago. This is the type of name that makes a lot of sense. 1.6% dividend yield. You much rather own this than a high debt 5% dividend payer, right? Because they have a very strong balance sheet, pretty much no debt in its balance sheet, and good cash flow, $573 million on $11 billion market cap. That's a pretty decent free cash flow yield, about 5% free cash flow yield. And they can certainly increase their dividend, and they do over time. So it's pulled back to support. It's about fairly valued in our minds. And so, you're getting a good company at a fair price at support. I have no problem adding to it at these levels. Thanks for the call. Now let's touch a bit on bank earnings. We have earnings season coming out next week, and there's going to be a stark difference between the major banks, especially the investment banks, and your regional bank. Why is that? Because of investment banking fees. They're set to rise more than 30% year over year during the second quarter. And that's all because there's been more large deals like ExxonMobil's acquisition of Pioneer Natural Resources. That was brokered by Citigroup, Goldman Sachs, and Morgan Stanley. Aon purchased an insurance broker called NFP in April. That was guided by Citi and BofA. So there's been some big M&A activity as well as more debt issuance with the yield spreads between corporates and treasuries pretty tight. Even though rates are higher than they have been in the past, hey, at some point you need to go to market. You need to finance yourself. And so they've been doing that. And investment banking revenues fell dramatically last year from a record high in 2021 to their lowest level in years. So what you're getting a lot is base effects. And that's important to understand here as well. Yes, 30% sounds like a lot. It's coming off a very, very low base. I see this a lot with housing. Oh, inventory is up 70%, but that's because inventories in housing has been very, very low. So a lot of it's mean reversion, but I digress. So when you're looking at numbers like that, you have to look at what the base effect looks like. And really, you've seen that you're going to see this counteracted with more losses set aside for defaults. And the 4 largest U.S. banks by deposit are expected to report more than $7 billion in charge-offs in the second quarter. That's up more than 50% from a year earlier, also from very low levels. So, there's a lot of counterbalancing factors here. But you need that investment banking side in order to stave off, major declines in earnings. And those regional banks, they don't have a lot of investment banking business. Many of them don't have any investment banking business. And so, everyone's focused on commercial real estate in particular. But that's kind of what you should expect with earnings going forward, is how much is that rebound in investment banking, and how sustainable is it? The Fed's likely to cut rates, and does that spark a wave of financing? You have private equity that are trying to refinance themselves as well, and so they'll be eager at the right price to issue more debt. And you have a lot of those private funds trying to go to market as well, right? Buying names that maybe in hindsight were too expensive, and still trying to get some money out of those deals. And so you'll see that likely to be a focus as well. So that's what you're likely to see to kick off earnings season. And it'll be very interesting to see if the broad market can live up to the high expectations for earnings as we go into the third quarter. Now let's keep things moving and pivot back to the InvestTalk voice bank at 888-99-CHART.
Hi, Justin and Luke. This is Kevin calling from Southern California. I've been increasing my small cap exposure over the past few months, maybe even past year, which hasn't been working out great so far, but hoping that it will catch up to the large caps in the near future, or even in the future. But I was doing some reading where various websites and podcasts and people are talking about how there aren't as many good small cap public companies out there anymore, because a lot of them have been bought by private equity companies, or the ones that are worth investing in are being held by private equity. I'm wondering what your thoughts are regarding this statement. And obviously there are still good ones out there, but are there less compared to before? Appreciate hearing your thoughts on the show, and thank you again in advance.
That is a good point, that private equity has swallowed up a lot of these smaller names that are of quality. But I will also say that the structure of the market, where you have a market cap market cap weighted indices that dominate, like the NASDAQ as well as the S&P, it pushes more money towards those larger names, and a lot of those larger names are more overvalued, versus less money continues to go towards those smaller names and kind of depressing the valuations there. And that's why you see kind of a record spread between those large caps valuations and small cap valuations. And so part of it is quality. You're correct, but a big part of that too is just the way that market structure has evolved with index funds dominating. And so good point, but I think it's counterbalanced. I think long term you will see small caps reassert themselves as the better performers, but you also will probably need to see a weaker dollar, because a big part of why small caps have underperformed as of late is the stronger dollar. And most of those companies are domestically focused. And so when the dollar is stronger, it means that their business tends to struggle. The overall economic growth tends to struggle. Their products and services become less competitive in the global market, et cetera. So I think you're likely to need to see a weaker dollar for those small caps to get that resurgence, which I think you do get over the next 12 months or so. Now let's go to Bill in Northern California. He wants to talk about BLBD, which is Bluebird Corp, correct?
Yes, that's right.
Okay.
Want your overall take and what you think at this price of the value. It's proposed as a growth stock in the next year or two based on their orders for electric buses.
You're saying electric buses? Oh, I see.
Yeah, so they're one of the top producers of electric buses, and they're getting. I don't know what I should probably do more research on the current deal with the government and contracts, but it looks like the government is, pushing them, and this is going to be a growth spurt for them in the near future, currently and going forward for a couple of years, as they're replacing a lot of older buses at a faster rate with the electric ones are, pretty, meeting all the criteria for environmental standards, et cetera.
Yeah, I got you. Yeah, so these are the yellow school buses that you see around everywhere, and it makes sense that they are replacing them with cleaner vehicles. But what's interesting here is that earnings are expected to start to shrink as soon as the third quarter. So you have expectations for the second quarter of earnings up 12% or up 19%, revenue up 12%. But third quarter, you have revenue expected up 8%, but earnings down 27%. So it seems to me, like maybe there's, I would do some deeper research on why that might be the case. And has the recent growth in earnings been more of a flash in the pan, or is that something that's more sustainable? What is the roadmap here and runway for this growth? Is it just a year or two, or is it something that is going to be a decade-long trend towards electrifying the bus fleet, school bus fleet in America? The good thing here is they have a good balance sheet. It's not trading at egregious prices based on current earnings. But like I said, if earnings do take a step back, which looks like they're expected to over the next few quarters, that would worry me a bit. But the technicals look fine. It's in an uptrend, and I would do more research on what's driving this recent growth and whether there's a bit more sustainability going forward. Thanks for the call. Now we're heading into a break, and our work continues. So my phone lines are open, waiting for your calls at 888-99-CHART. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors. Now here's another question from our InvestTalk YouTube channel. Adam Wright 8 Fool says, since one can never be sure how long they will live, an annuity plan is a true retirement plan. Just as term policies are purchased to protect against early death, an annuity plan does the same. I have a big problem with this comment. The first sentence doesn't make sense. They don't connect. Since one can never be sure how long they will live, that's true. An annuity plan is a true retirement plan. No. An annuity, as I said with the earlier caller, is to supplement income. That's it. It's what you use an annuity for. You're right. You never know how long you're going to live, but you can model out, based on reasonable assumptions, how much a certain dollar amount will get you. And you'll be able to pull out each year, even in a conservative, right? Treasuries, for example. Okay. And he says, just as term policies are purchased to protect against early death, which is true, an annuity plan does the same. No, an annuity plan actually does the opposite. An annuity protects you against death far out, meaning, hey, I've lived so long that I outlive my money. And, that's probably the best argument for an annuity. Hey, what if I live to 105? Am I going to have enough money to live that long? Because remember, when you buy an annuity, money doesn't pass on. It's just until you pass away, or if you get a survivorship rider, maybe some of it goes to your spouse, etc. So interesting comment, but I wanted to correct it because it makes it seem like annuities are a good idea, and they can be, but for very select few people. Okay. Now let's talk a little bit about Vanguard. And Vanguard ranked last out of 8 major brokerages for customer satisfaction. This is a survey by Investors Business Daily of 2,700 different investors. Why is that? Well, frankly, they haven't invested in technology and they don't have good customer service. Now, I'm not here to bash Vanguard as a corporation. What I'm here to talk to you about is that fees are not the end-all be-all, right? Vanguard is all about lowest fees, and it's good. It's good to focus on fees, but it should not be your overarching only thing you focus on, right? It's what does the whole experience look like? If I need to get something done, like a Roth conversion, for example, which can be very important and save you millions more, maybe not millions, but thousands more than you'll save on fees in your entire life by doing a Roth conversion at the right time. Vanguard's not going to help you with that. And if you want to do that, they're probably not going to be able to execute that in a timely manner, according to these surveys. And so the lesson here with really the bad customer service satisfaction at Vanguard is, why does anyone have a brokerage at Vanguard? It makes no sense. You can go buy a Vanguard ETF at any brokerage firm. Schwab, Fidelity, E-Trade, any of the top 8, right? For no cost. Trading fees are next to nothing now. Same fee, but you get better service. For example, Schwab and Fidelity have 24/7 customer service. Now, I'm not saying that those companies are flawless. They're not. We use Schwab. They had a lot of issues with the merger between Schwab and TD. They've mostly cleaned a lot of that up. But it's, based on the rankings here, far better than Vanguard. There's no reason to have money at a mutual fund company. It doesn't do you any good, because you can access ETFs in the vast majority of mutual funds and individual stocks at one of the larger brokerage firms that gives you much better customer service and better data. That's a big part of it as well, is the user experience of trading, of getting data on the investments that you're looking at. And so when you're thinking of a broker and your brokerage firm you're working with, make sure you take it all into account. Don't get hyper focused on one thing or the other. Make sure it fits what's best for you. And if you want to do things like Roth conversion planning, financial planning, you're going to need an advisor, which Vanguard's not going to really help you with either. So I just wanted to highlight that because it's important to have a well-balanced view of which broker you are working with. That about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And head over to YouTube and check us out in video form and see all the data that we are looking at as we analyze individual companies. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.